Economists have a bad habit of naturalizing or universalizing the institutions of capitalism, as though capitalism has always existed and will always exist. Nothing could really be further from the truth, and I want to disabuse us of that notion in this video by looking at some of the recent history of how capitalism, especially in the United States, has changed. So we can trace what we might call modern capitalism back, especially to the late 1800s, the late 19th century, and what we could call industrial capitalism. That changed into the early 20th century with the development of the modern corporate form and modern financial markets. And by the mid-20th century, we're looking at what we might call managerial capitalism. That, however, will evolve again into money manager capitalism by the 1980s, and we could say we're still in this period of money manager capitalism today. Now, in this video, we're not going to have time to cover all of these phases of capitalism. I just want to look at the last two components, managerial capitalism and money manager capitalism, and understand some of the economic history and the policy regimes of these two periods. And I want to look at this in terms of the sectoral balances model that we've looked at previously. Just to give a brief review of that, the blue bars here indicate your private sector in the United States. That's your households and your businesses, your nonprofits, and so forth. The red bars indicate the public sector. Think of that as the government's sector, and the green bars represents the foreign sector. If a bar is above that zero line, then that sector is in surplus, and this is all in percent of GDP. Whereas if a bar is below that line, then that sector is in deficits. I also want to bring in a breakdown of just the private sector in particular here. You can see in the seafoam green, or whatever that color is, we've got household balances. Again, surplus above the zero line there, deficits below. And this actually includes other institutions, your nonprofits as well. But we'll focus on households here. The purple then represents your businesses. So with that, let's look at managerial capitalism, which runs from, say, roughly the 1930s or 40s through the 1970s. Now, we call it managerial capitalism because those are the people that dominated capitalism in the United States in this period, specifically the corporate managers of the large corporations. We can see in this period with our sectoral balances that the United States ran a fairly balanced trade, although with small trade surpluses, what we'll call the rest of the world's deficits, while the United States maintains its position of manufacturing superpower in the world post-World War II. We can also see that the private sector over this period generally runs stable surpluses of around 4 to 5% of GDP. And then, of course, that's matched by public sector deficits of about the same amount, maybe a little bit smaller. The policy during this period is traditional Keynesian. Nixon himself is quoted as saying, "We're all Keynesians now," although I'm told that somebody else actually said that. This American type of Keynesian, though, is particularly militaristic. A lot of the spending that the government is doing to prop up demand, to prop up employment, and so forth, is of a military variety. But what we see in this period is what's often called the golden age of capitalism, from about the 1940s to the 1960s. This is a period in which American workers enjoy strong unions, and overall, the American economy has a large job-secure middle class, and that's important because a middle class who enjoys job security is more likely to spend their income, which is going to constitute the kind of economic engine of the entire economy. The upper class and parts of the middle class then participate in savings, and this is where we see those relatively large private sector surpluses. Meanwhile, in terms of the corporations themselves, we see relative autonomy from the financial markets. Wall Street practices over this time what's called the Wall Street rule, which simply means if I own stock in a company and I don't like the way they're being run, I just sell the stock. I don't try to influence how the company is managed. The large banks at this time play a coordinating role through what we call interlocking directorates. The way this works is, say I'm on the board of directors for General Motors. Now, legally, I can't also be on the board of directors for Ford because that would violate antitrust law. But I can legally be on the board of General Motors and the board of, say, Bank of America. And somebody at Ford, one of their directors, can also be on the board of Bank of America. And what this does is it allows an indirect but still fairly comprehensive way of coordinating inter- and intra-industry economic policy for private corporations. But otherwise, you can see that businesses invest fairly substantially, in fact, through this period, but they don't run large deficits. And this is because most of that investment is being financed not through borrowing, but through retained earnings. The 1970s, things start to change. We see a period of crisis and what we call stagflation. If Nixon said we're all Keynesians now, unfortunately, he was the wrong kind of Keynesian, the bastard kind of Keynesian, as Joan Robinson would say. When Nixon took office in 1969, he saw a fairly large and accelerating inflation, and he tried to address that problem using standard neoclassical tools. Unfortunately, those tools do not really line up with how capitalism works by this time, and what we ended up getting was an intentionally created recession beginning in 1969 that didn't actually stop the inflation. So the economy stagnates over this period. At the same time, we see high and accelerating inflation, giving us this phrase, stagflation. This is only made worse throughout the 1970s with a series of oil price shocks, as well as gradually encroaching foreign competition into what was the manufacturing superpower of the world. So this moves us into the 1980s, where we start to see the rise of money manager capitalism, a form of capitalism dominated by, you could say, Wall Street, the financial institutions, whether investment banks or mutual funds or private equities firms or hedge funds. We just call all of these money managers. The 1980s, we start to see these money managers assert their authority over the corporate world, and they do so through what we call leveraged buyouts, LBOs. An LBO essentially works like this. I run a small private equities firm. I borrow a bunch of money, usually from a pension fund or a mutual fund, and I buy out a controlling interest. I buy the stocks of a corporation that I want to control. Once I have control of that corporation, I fire all the managers and I lay off usually as much of the workforce as I possibly can. And then most importantly, what I do is I use that corporation to borrow a bunch of money in that corporation's name and then issue from that corporation what's called a special dividend. That's money straight to me. I can use that to pay off the people I borrowed the money from initially and to buy a yacht or whatever I want. So essentially, these leveraged buyouts are just a form of financial engineering that allows a private equities firm to saddle a corporation with large amounts of debt to pay the private equities firm off. And these leveraged buyouts were rampant in the 1980s. Other things we see in this decade is a growing trade deficit as those foreign competitors start to encroach into the U.S. markets. We can see this here as the foreign sector surplus, our trade deficits, begins to expand over this period. And of course, that means the public sector has to offset with a larger deficit to cover not just the private sector surplus, but now also the foreign sector surplus. And in the 1980s, under the Reagan administration, what we see with these deficits is especially an expansion of military spending, furthering that notion of military Keynesianism. Moving then into the 1990s, what we see is the large corporations across the United States have all more or less adopted a principle of maximizing shareholder value. And this is just the common phrase for saying that corporations don't owe anybody anything except for their shareholders. We also see in the 1990s a bipartisan effort to deregulate the financial markets and the financial industry more generally. And once again, all of this lends credence to the idea that we've moved into a period of money manager capitalism, a capitalism dominated by these financial institutions. But we could also call this maybe privatized Keynesianism, a capitalist economy in which spending is supported through household debt in connection with an expanded and increasingly complex financial sector. In this period, especially beginning in the 1980s, what we see is wages stagnate. The unions are busted and work becomes less secure. All of this coincides with the beginning of the shrinking of that middle class, that engine of spending in the economy in earlier periods of American capitalism. But what we also see is that household spending doesn't actually decline. It actually continues to grow as well, and it does so through increased household borrowing. Here we can see in the green the expansion of household mortgage debts going all the way back to the 1950s. You can see this really starts to expand in the 1980s and then once again even faster in the early 2000s. In the brown, then, you've got households' consumer debt, which, as you can see, really starts to expand in the 80s and has only continued to do so up until the present. So as Colin Crouch, the person who coined this term privatized Keynesianism, has argued, instead of governments taking on debts, which is to say running deficits to stimulate the economy, individuals now stimulate the economy by taking on debts, by running the deficits. So back to our sectoral balances, we can see that private sector surplus, which had been fairly stable at around 4, 5, maybe upwards of 6% over the last several decades, started to decline in the 1990s. You can see this in the breakdown of the private sector itself. Those household surpluses got smaller and smaller and smaller at the same time that in the late 90s, business deficits were getting bigger and bigger. What this did was it allowed the private sector to run a deficit and eventually to achieve that miraculous feat of a government surplus. You can see just in those little tips of red, the government running a surplus in the late 90s. Now, back in the 90s, if you're a Republican, Newt Gingrich was a genius. He had finally accomplished the impossible. The government had actually run a surplus. If you were a Democrat, Bill Clinton was a genius. He had finally accomplished the impossible and run a government surplus. If you knew anything about national accounting, though, you wouldn't have given either of them much credit. Instead, you would have looked to the credit card companies and the mortgage banks and all of the other financial institutions that allowed that shrinking middle class to continue to expand its spending through borrowing. And we see this especially in the late 90s into the early 2000s with the housing bubble, the first housing bubble the United States had seen, which was essentially national in scope. As people saw housing prices go up and up and up, they were more and more willing to borrow more and more money to buy more houses. As people bought more houses, that drove prices even further up, which meant even more borrowing to pay even higher prices for even more housing. All of this, of course, has to burst at some point, and it did so in roughly 2006 to 2007, leading the economy into the Great Recession, the worst recession the U.S. had had since the 1930s. And you can see then during this period, households and businesses began to deleverage, which is just a way of saying they began to stop spending, mainly so that they could pay off the debts that they had accumulated previously. Now, of course, as you've learned previously, it may be fine for an individual to be responsible and try to pay off the debts they've accumulated, but if everybody in the economy all at once tries to do that, all you're going to get is that paradox of thrift situation, in which everybody tries to save or not spend to pay off their debt is essentially the same as saving. It's not spending. And by virtue of not spending, nobody has work. And by virtue of nobody having work, there's no income to pay off your debts in the first place. This scenario, of course, can be prevented if the government is willing to step in and run larger deficits, which is exactly what we see in this period. Through automatic stabilizers and stimulus legislation, the federal deficit increased fairly dramatically. Now, part of that stimulus went to more generous unemployment benefits and a payroll tax cut, but the bulk of it was really a bailout to especially the banking system and General Motors. The largest banks by 2008 had come to be recognized as, quote, too big to fail. That is to say, policymakers consider these largest financial institutions so economically important that they cannot be allowed to go bankrupt. And it's also worth noting that these banks are essentially, if only implicitly, considered too big to jail, which is to say, even if they were in parts responsible for the housing bubble and the recession itself, even if that took place by way of illegal behavior, the government generally was not going to prosecute these banks for that behavior. Instead, what they'd receive was, at worst, a relatively small fine for any wrongdoing. I liken this to if I stole a car and got caught by the police would then take the tape deck out of the car and give me the car. Not, of course, much of an incentive not to commit grand theft auto. Following the Great Recession, what we see is a decade of relatively anemic, weak spending, and of course, correspondingly, relatively anemic growth in the economy, but the one silver lining, at least, it was the longest expansion in the U.S. economy post-World War II. So that wraps up this brief history of the U.S. economy.